There was a news about Fed interest rate hike, and as a data scientist in financial area, I wanted to read the article and compare the data point mentioned in the article using the Fed Fred site. This article is published by Wall Street Journal. Title says Fed raises interest rate by 0.75 percentage point for third straight meeting. Fed officials voted unanimously to lift their benchmark federal fund rate to range between 3% and 3.25%, a level last seen in early 2008. Nearly all of them expect to raise rate to between 4% and 4.5% by end of this year, according to new projections released Wednesday. Here is the Fed site showing the federal fund target range. In the red line, we can see for the last three consecutive, the result of FOMC meeting, there was a 0.75 percentage hike, and the latest result of September is now pointing to 3.12 as a midpoint. And here is a purple dashed line showing the projection for the Fed fund rate. 2023 projection midpoint is showing 4.4 percentage and 3.6 percentage by end of 2024. And in 2025, projection is 3.5 percentage. We've got to get inflation behind us. I wish there were a painless way to do that. There isn't. Fed Chairman Jerome Powell said at a news conference after rate decision. Stock market tumbled after volatile trading day. Broad S&P 500 index fell 66 points or 1.7% to 3,789.93. The yield on two-year U.S. Treasury notes settled around 3.993% from 3.962% Tuesday, nearly a 15-year high. Just after Fed announcement, it had touched as high as 4.12%. Meanwhile, yield on longer-term Treasury fell since a higher rate could lead to sharper economic downturn. On the right, showing the market yield on U.S. Treasury at 2-year and 10-year maturity. The latest result of yield of 2-year bond is 4.02, raised from 3.45 in August. So 2-year bond yield is increasing. If we look at the 10-year bond, yield is now actually decreasing. Let's zoom in. The latest 10-year yield was decreasing from 3.57 to 3.51 because interest rate hike imply the recession. And as the article said, the yield rate is similar to as high as that interest rate of 2007, so 15 years ago. Official projected that rate rises will continue into 2023, with most expecting the Fed fund rate to rest around 4.6% by end of next year. That was up from 3.8% in their projection this past June. Analysts said they haven't expected the Fed to show quite so high an endpoint for the rate. Given how persistently elevated inflation has been, I wouldn't be surprised to see them go even higher than what they have written down to 5%. Here is the projection for the Fed fund rate. As we can see, September projection is 4.6%, whereas June projection was 3.8%, and the September projection stay as 3.9%, quite high for the rest of 2024, and is going to expected to decline in 2025. Let's move on. Even though the economy isn't showing the full effect of Fed rate increases, all of this volatility and uncertainty make it hard for business to make plans. There are some benefit to having this hike of interest rate over and done with sooner. 1 year ago, Fed was signaling rate might stay near zero for another year, and it was purchasing treasury and mortgage security to provide additional stimulus. Officials misled the strength of economies' rebound from pandemic and how high inflation would rise. They are now raising interest rate at the most rapid pace since 1980s and have approved increases at five consecutive policy meetings starting in March, when they lifted the Fed fund rate from near zero. Until June, the Fed haven't raised the rate by 0.75 points since 1994. Officials made a second such increase in July, but signaled more concern about overdoing rate rises, which, together with investor optimism about how quickly inflation might decline, feared a market rally. Rallies threatened to undercut the Fed's step to slow the economy and weaken price pressure. And Powell delivered a blunt speech last month in Jackson Hole, designed to underscore the Fed commitment to reduce inflation. To limit further confusion on Wednesday, Mr. Powell prefaced his answer to reporters' questions with a disclaimer: "My main message has not changed at all since Jackson Hole," he said. Throughout his press conference, what Chair Powell was trying to do was keep to minimum the biggest risk to getting inflation to come down, which was market participants getting ahead of themselves and actually easing financial conditions. The higher Fed raises rate, the greater the risk that it's going too far, tipping the economy into recession. But Powell repeatedly emphasized the need to bring inflation down to avoid the even worse recession later. No one knows whether this process will lead to recession, or if so, how significantly that recession will be. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nevertheless, we need to complete this task. Economy slowed in May and June, but appeared to regain momentum through summer. Mr. Powell said Wednesday that Fed wanted to see more evidence that labor market was cooling off. Economy has added average of 380,000 jobs monthly over the past 6 months, far above the rate of about 50,000 that economists think would keep the unemployment rate steady. Meanwhile, inflation reading haven't worsened this summer but haven't showed the kind of improvement Fed and many economists have wanted to see. Falling gasoline prices caused overall inflation to ease in July and August, but climbing housing costs and prices for service such as dental and hospital visit, haircut, and car repair have kept inflation elevated. The consumer price index rose 8.3% in August from a year earlier, down from June increase of 9.1%, a four-decade high. Mr. Powell pointed to how inflation using separate gauge has consistently run at a pace of 4.5 percentage or higher despite diminishing supply chain problem. Here we can see customer price index overall and excluding food and energy. If we look at the CPI excluding food and energy, we can see that it was July, it was 5.9 percentage increase. Then August it increased again to 6.3 percentage point. Mentioned in the article that it was due to the increase of services or the healthcare or the haircut, etc. Fed official projected unemployment rate rising to 4.4 percentage next year from 3.7 percentage in August and 3.5 percentage in July. Historically, increase of that much in that span has coincided with recession. Again, if we go to the Fed site, here is unemployment rate, actuals, and also the projections. And projection shows 4.4 percentage into 2023 and 24. Several analysts said they found it's impossible that Fed officials projected they might bring inflation down to 3% next year and 2% by 2025 without doing more damage to labor market. At the same time, Mr. Powell appears to be more candid about the risk. He's using words that are open to recession. U.S. mortgage market has been slammed by prospect of tighter money. An average 30-year fixed rate mortgage jumped to 6.25% last week from 6.01% the week before. That was the highest level since October 2008. Application for loans to purchase home were down 30% the same week last year. Last data point mentioned in the article is 30-year fixed rate mortgage average. We can see that it was up in September to 6.28 from August 5.13 percentage point. Mr. Power said it was likely that the housing market, which boomed during the pandemic, driving prices to new high, would weaken significantly. Mr. Reinhardt said that mission was notable because economy has always entered a recession when housing sector has contracted. They wanted to convey the policy will be firm and the economy will suffer as a result. It's hard for them to say how much it will suffer, Mr. Reinhardt said.